Okay, guys, welcome back to Macro Insight. Today is the 9th of March, and let's talk about these markets. So what's been going on? Obviously, rates have been the main driver, driving more unwinding in the tech sector last week. Retail favorites such as, say, the ARKK Innovation ETF, so like the low earnings, long duration growth stocks, they're the ones that have been getting killed the most. So we were saying that, last week it was all about the tech stocks and the big unwind in the tech sector, right? So as yield went higher in the US, that was driving these like low earnings, long duration growth stocks to come under pressure, and they were getting particularly killed, right? So, something that's been getting a lot of press is the ARKK Innovation ETF that is run by Cathie Woods, which has done phenomenally well for the last 12 months, but has been getting particularly hurt recently, right? So the ARKK ETF, I mean, if you have a look at some of these weekly return numbers, basically it's kind of down 3 weeks in a row, and some of these negative returns are as large as, we haven't seen numbers like this since sort of last March, right? In the liquidation last March of COVID, right? So that's looking particularly bad, and some of those outflows, some of the volumes are quite high there as well, right? So decent outflows coming out of there as people getting worried that these tech companies that have very little actual earnings right now and were being, had massive price multiples, they're being slightly re-rated in this world of higher yields, basically, right? So that's kind of one of the main things that's been getting the press. Another interesting sort of chart to keep an eye on is the NASDAQ 100 PE, right? And kind of just how much that's re-rated and how high that actually got, right? So let me share this one. Look here. So there's the price, there's the valuation of the NASDAQ 100. So it got as high as 30, the PE. But if you look at, it came from 18 in March, had a phenomenal run, and is now kind of, so as yields go up, you could expect this PE to kind of come under pressure, right, in tech. So looking at that, it wouldn't be completely out of the question in a rising yields environment for this PE to come back to something like 24, which is arguably nearly another 10% lower in NASDAQ, basically, right? Assuming earnings are unchanged, right, or where we expect them to be. So just to get a flavor of how much more downside maybe we could have in the NASDAQ if yields continue to go up, say towards 2% or something like that. Okay. So that's kind of a couple of graphics I thought I'd share. Now, energy and financials obviously have been the beneficiaries of this kind of move out of growth and into the value sectors and into the sectors that do okay in a higher yield environment. So since the tech stocks topped out on the 16th of February, the tech sector is down about 10%, whereas the XLF, which is the financials, that's up 6.5%. And the XLE, which is the energy sector, that's up 15%, right? So massive divergence between what's going on in tech and what's going on in the rest of the market, right? And that's why, if you look at the S&P itself, that hasn't really sold off that much off its highs, more in the order of magnitude of 4%. And that's because those other sectors have been those massive beneficiaries. Now, tech obviously makes up a large part of the S&P because those mega cap tech stocks are obviously very, very big components. But, clearly the S&P is being helped by the banks and the energy stocks doing so well, okay? Now, on this kind of yield uptick last week, we kind of were looking for Powell when he was speaking on Thursday to give us some kind of color and some sort of idea of what the Fed might do to backstop yields if the market was wobbling on that. If the market didn't like that and that was creating too much stress and tightening of financial conditions, what would the Fed do? And they pretty much offered nothing, right? So, he didn't seem concerned about what was going on. He was saying how yields going up is normal as growth improves. So all of these sort of things. And the market just didn't like what he had to say and sold off quite dramatically afterwards. Right? The market had got a little bit kind of hopeful that he was going to talk yields down And then when he failed to do that, then the market sold off again and yield spiked to about 160 basically, right? Now, after that happened on Thursday, so that was kind of the height of the weakness in yields. But then on Friday, we had non-farm payrolls that came in much stronger than expected, right? So you had expectations of just under 200,000, and we actually had more like 400,000, right? So now, normally on a strong non-farms number like that, you would have expected yields to go even higher because that's signaling, you know, better growth, better job creation, etc. But actually, yields didn't do much. If anything, they kind of settled down a bit. Now, looking deeper into those non-farm numbers, it was because most of those jobs came from the hospitality sector, and that was the most beaten down sector. So an increase in an extra 200,000 jobs beyond expectations, but all coming from that sector, that can kind of be taken a bit with a pinch of salt because that sector has got so badly beaten up that it's not necessarily telling us that much about the underlying economy overall. We're seeing a decent bounce in hospitality because things are going to start reopening basically, or things have already started to reopen. So the market kind of took that with a bit of a pinch of salt, and yields didn't keep going, right, which kind of helped. And you had some very, very choppy price action on Friday. Like I said, that ARKK ETF at the intraday lows was down 9% at one point on Friday, and then it only finished the day down like 2% or something like that. So massive reversal there. Definitely felt like a bit of a liquidation panic in some of those growth names, but just very, very choppy price action. Okay. What else have we had over the weekend? We've had the Senate passing the 1.9 trillion relief package. Not a major surprise. That could obviously lend some support to markets if people were to invest their stimulus checks into the market. Those, they're trying to get that signed by the 14th of March. So I don't know exactly when the checks will hit people's accounts, but probably sometime later in March. Maybe that provides a bit of support to the market. I guess we'll have to wait and see. We didn't really get any reaction in the dollar or any reaction in bonds on the back of that stimulus passing, right? I mean, on Sunday night, the market did have a bit of a gap higher, but that got faded pretty quickly and kind of, didn't really manage to hold up into Monday, right? The more important thing that's kind of driving weakness, I think, right now is China, right? So you've basically got China emerging as a bit of a risk to broader markets right now, especially commodity markets, but just markets in general. The Chinese stock market, as I had flagged last week, has been a bit weak, has come off quite strongly off its highs. But then the authorities stepped in as the Shanghai Composite was down 3% intraday today. It seems that they intervened, stepped in and took that market back up, right? So China already starting to support their market, not really wanting their equity market to fall out of bed here. As I had again flagged, I didn't think they were going to let that happen. But what it does show you is some of that growth, some of that demand coming out of China that we've seen is maybe going to have a bit of a pause at the very least, right? So that does leave commodities at risk in the short term. And we'll talk a bit more about commodities in a minute. But yeah, that's definitely something to keep an eye on. And also, given Europe is quite dependent on China in terms of a lot of its exports and stuff, that's probably not going to be great for Europe, right? Now, let's take a bit of a look at the charts. I had been, looking for the NASDAQ to reach that sort of 12,500 level as a bit of a potential buy zone. But the way it sliced through that and went all the way to 12.2 kind of made me step back and say, all right, this is not really looking too great, and I don't really want to catch a falling knife, right? So particularly when you've got liquidation going on in things like the ARKK ETF, I think, and there's some serious fragility building there, right? So apparently Cathie Woods has been saying that when markets go down like this, she tends to sell all her liquid names, like, Tesla, the large caps like Tesla or whatever, and she buys the real beaten up small cap stuff, right? Now she's saying that's because that's where the opportunity is. The market's, overreacting to the downside. Liquidity is thin. That's where I'm going to pick up the bargains, basically. And, to an extent, she's right. But the problem is she doesn't really seem to care that much about risk management, right? So generally, when markets are going into bear mode and markets are getting nervous and selling off, you want to be in liquid stuff, right? So you can manage your exposures and you can manage your risk. And I just think that's what she's doing, the way she's kind of trading that. And she's not really a trader, right? She's a long-term investor, and she holds this stuff for a long period of time, and she doesn't care too much about drawdowns. But I guess the problem is when the ETF gets so big, there's so much money parked in that. Some of the money that's parked in the ETF might not behave quite in the same way that she does. So if she does experience drawdowns of like 30 to 50%, some of that institutional money might then say, all right, we want out. And that forces liquidations because she needs to like sell her illiquid holdings. And that can become a bit of a exaggerated self-fulfilling prophecy, right? So that does worry me, because I do think, given how big that fund has got recently and the amount of retail money that got excited into those names as well, that we are seeing that unwind happen. And if yields do continue to go higher, then that unwind may not be over yet, basically, right? So that does worry me. And that kind of makes me way more cautious on this market than I maybe was 2 weeks ago. Okay. Now, in terms of levels, I do think that basically the NASDAQ levels to kind of keep an eye on. I think I want to see the NASDAQ basically above 12,800 to feel like this thing maybe has some legs on the bounce. You know, for now, I'm not seeing that. It's kind of chopping around between that sort of 12.6 and 12.3 levels. But like I said, I'd want to see it back above here, back above sort of 12.8, to think that maybe we're going to stage a little bit of recovery for a couple of weeks. And that needs to basically come with bond yield stabilizing, basically, right? So you don't want, you've got some bond auctions this week. And if those go badly, then obviously yields are off to the races again, and that's not going to be great for tech. But if we can basically stabilize in yields for a week or two, we can maybe get tech back above into that 13 handle. Then maybe we get a bit of respite. Yeah. But for now, I'm not seeing anything in the price that's kind of making me feel overly confident or comfortable. In terms of levels on the NASDAQ, I mean, I think downside level for me is going to be around this 11.8 area. And then you got the 200-day moving average that people love to look at around sort of 11,650. So if the weakness persists, I mean, that's kind of a sensible target for where NASDAQ could get down to. Like I said, I'm not overly playing that, but I am thinking I'm not really wanting to buy this stuff until maybe we get down there and it feels like the move is kind of exhausted. Right now, we're kind of in no man's land, and I'm not willing to call an end to this sell-off right now. So I'm kind of in wait and see mode on that. I'm actually, the interesting thing is that I think the market's quite short gamma. So, you know how we talk about dealers being long gamma or short gamma based on the flows that are out there. So if I share this screen, hang on a minute. So there's this website called Spot Gamma that basically tracks, gamma positioning. And they seem to be, you know, how accurate the data is, I wouldn't be able to tell you, but you know, I think they've got a reasonable idea of what's going on. So they've got the triple Qs here, right? So this screen is showing what the gamma levels are, dealer gamma levels are for different levels of the triple Qs, right? And the triple Qs, you know, currently trading around that, where is it? Triple Qs are around 300 right now. So it's quite a big negative gamma exposure that the street has. So you only get out of that when the NASDAQ's back above 330 or whatever, where there's no real gamma position. But right now, there's quite a big negative gamma position in the Qs. So that's kind of showing you why the Qs is so schizo at the moment, right? And going up and down like, you know, the NASDAQ's moving up and down a few hundred points like crazy. And doesn't really get any sense of direction because people are just short a load of gamma and they're chasing it in both directions, right? So moves are just being exaggerated at the moment, and the market's struggling to find equilibrium because the street has been caught a bit short gamma, basically. So that's quite an interesting point, I thought. So let's go a bit closer into commodities, talk about what's been happening. So oil. First commodity we'll talk about is oil. That's been going a bit crazy, obviously. A couple of things been happening there. So oil broke higher last week after OPEC Plus failed to increase production, which the market was kind of speculating they were going to do, and they didn't. So oil ripped higher on the back of that. And then over the weekend, you had this kind of drone attack on one of Saudi Aramco's oil facilities, yeah, which created another overnight weekend spike of $2 or $3. So that's why you had that explosion up. I think Brent touched like 70, got above 70. But now we've pulled back a little bit as it seems the damage from the drone strike wasn't very big, right? So there's not going to be a massive supply disruption or anything like that. But in general, the trend in this oil market is just bulletproof, right? So even in the face of other commodities correcting, oil doesn't seem to really care, right? So definitely a very, very strong sort of trend within oil. And that's obviously helping some of these oil stocks as well that have been flying, right? So that's kind of oil. I wouldn't really get in the way of that. Gold, which we've played pretty well. So, I mean, I've been trying to get an idea of what I think if gold actually breaks. So we'd marked out these blue levels, right, as the key levels, and we pretty much touched that 1670. We got just shy of it, right? So it was kind of obvious to play like a tactical bounce trade off that support, because that's the first time we're touching that major support, and the market's already at 1715, right? It's kind of done exactly what you would have expected. But if we were to turn south, you know, what type of levels do we need to look at next? And I'm kind of seeing this sort of uptrend that gets us to about 1570 as kind of a next major support, right? If we were to break that. So another 100 points down quite easily if gold takes that out, right? So that's kind of what I would be keeping an eye on. You know, gun to my head, I probably think that is where we're headed, in that I don't think there's much holding gold up right now. Yeah, I think if the Fed isn't going to step in and stop the longer end of the yield curve from going higher, then I just don't think there's much stopping gold from going lower, to be honest. I think that is the main driver and will continue to be the main driver. Yeah. The flip side, China, if China does kind of start to soften up a bit, then overall maybe that puts the environment for wanting a bit of a safe haven in gold and stuff like that. Maybe that is a bit of a shift towards that. Who knows? But whilst real yields in the US keep going up, gold's going to be under pressure, right? So then on that, where do you sell gold if you think gold is going to resume the sell-off? So, I mean, my target for this little bounce has pretty much been reached, right? So, we were at the lower Bollinger. We bounced to the top Bollinger on the 4-hour chart. It's kind of, I mean, it could start selling off here. I mean, I've got levels up at 1728 and again at 1760. I'd be surprised if it manages to get all the way up to 1760. So I'm out of my tactical long already. I got rid of it at 17. I put it on yesterday. I'm out of it at 1715. That's gone. I probably would put on a cheeky short at 1728 to play the downside again. Yeah, that's probably how I'd look at it, and maybe even sell some more at 1760 if it gets there, basically, right? But because like I say, I don't think we've seen the highs in yields yet, and I think this is a way to kind of play that. Actually, I'd look at where the vol is. Maybe buying puts again in this stuff is a better way to kind of get that, because breaking that 1670 level could trigger a fair amount of volatility to the downside in gold. So actually owning some leverage to your premium and owning puts might not be a bad shout. Right, so base metals had a bit of craziness last week. Right, so you had nickel, which I didn't have a lot of fun with. So I left some resting bids on nickel that got obliterated. So if you bring up the chart on nickel, I mean, it was very gappy, right? It just gapped through levels and didn't look back. Basically, you had some inventory come in quite high, right? So LME, London Metal Exchange warehouse stocks came in high in nickel first, and then that triggered some kind of speculative liquidation. Like apparently a few funds had got very long in the metal space given the price momentum that it was showing. So there was a bit of puking that needed to be done. And that market isn't particularly deep and liquid when people want to get out. they can cause quite big dramatic moves in there, right? So that's what was going on with nickel. Copper had a similar type story in terms of inventory build, managed to trigger a sell-off in there as well. But that was down to some nice retracement levels, right? So if you look at these retracement levels on copper, it got down to that sort of 1390 area, which kind of, well, it kind of overshot through it intraday, but managed to hold. So managed to pick up some at 390. I flipped it out of 410 when I saw what was going on with China and got concerned that the commodity sell-off isn't done yet. So I think it's one of those, you kind of wait and watch. I did pick up some longer term exposure in both nickel and copper, and I'm keeping that, and that's long term. So I'm not as bothered about the short term swings on that. But in terms of tactical, I got stopped out of my nickel, and I'm not in copper right now. I did play the quick swing on that. I took a bit of money out of that to compensate what I lost on nickel. So yeah, would be looking for copper price action to kind of retest the lows, maybe stabilize around there, see what's happening with China, and maybe think about a tactical long again. But at the moment, some of these commodities are pretty high vol, pretty risky to be messing about too much on the day trading side, right? So I'm kind of structurally picking up commodities that I like and deploying cash in the pension that was parked and ready to go. So I've been picking up uranium miners, I've been picking up copper, I've been picking up copper ETF, nickel ETF, stuff like that, basically. So just building up a bit of my overall commodity pot and commodity exposure for the long term, because I'm in the camp that does believe that we may have begun the next sort of commodity cycle, like long-term cycle, and just having a decent percentage of your pension money allocated in the commodity space. Not only does it make sense from a fundamental perspective with a lot of the demand drivers coming through for copper and things like that, it also holding sort of real assets in a world that is kind of being inflated away with money debasement. You feel a bit more comfortable, and you feel more comfortable in industrial commodities than you do in gold right now because of the way real yields are working, basically. Yeah. So for people who do own a bit of gold in the long-term pot, I don't think it's necessarily a bad shout to be switching out of some of the gold ETFs into things like copper ETFs, basically, right? Especially because copper's had a bit of a pullback now. Now, it may well have some more room. I think down towards that 375 level would be a lovely little entry point if it got there. But I think diversifying out of some of your commodity ETF exposure into copper out of gold might make quite a bit of sense. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our Summer Academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.